Hello everyone, my name is Milhan Baig. Today we have Professor Damodaran with us in PwC Luxembourg, who will be answering some insightful questions for us. So Professor Damodaran, thank you very much for having us here today.
I'm glad to be here.
I'm going to kick off with the very first question for
Okay.
you. So when we undertake valuations, quite often we find ourselves entering into a price versus value debate. We are asked to value an asset or a business, but we find there's a casual interchange between the two terms. So what are your views around that?
I think if it were a debate, it would be much healthier. The problem is there isn't a debate. People use the words interchangeably, and they're not quite clear what they mean. They act like they mean the same thing. But if you think about it, the two come from very different places. We know what drives value. It's cash flows, growth, and risk. We can dance around those three variables as much as we want, but that's what drives value. If you think about what drives price, it's demand and supply. When you think about what drives demand and supply, it could be all those fundamentals, but it could be mood, it could be momentum, it could be 100 other variables. So when you think about price, you can think about the fundamentals, but you got to think about the rest of the market as well. What that effectively means is the two processes can deliver two very different numbers.
Right.
So when you come to me and say, I'd like to price an asset, the way I approach the process and the number I deliver to you can be very different than if you come to me and say, I'd like to value that same asset. So one of the first things I would do if this were the business I were in, if somebody walks into my office and say, I'd like to put a number on a company, I'd say, do you want me to value the company or price the company? And their first reaction is, what's the difference? And part of your job in valuation is to explain to people what the difference between the two are and why you might be looking for one as opposed to the other.
Right.
I'll be quite honest, 95% of all valuations out there are really pricing.
Right.
We like to call them valuation because it sounds more fancy, but it's really pricing.
So we take relativity from market multiples.
Exactly.
And how others are pricing a similar asset or a business, and then we draw our conclusion of value based on other
Conclusions
people's.
about price, based on
pricing.
what other people are paying.
Right. Okay. So how important are valuations in conducting a deal? So getting to the right valuation, not the pricing, the valuation in conducting a deal. And how can good valuation estimates help deliver deal value for companies when they're looking to do transactions or M&A?
The problem is valuation is almost inconsistent with the notion of a transaction. To get a transaction done, you really have to get the pricing done, right? It's like trying to sell your house. If you want to sell your house over the next month, there's no point you telling me what you think your house is worth.
Yeah.
You have to look at what people are paying for houses like yours. So if you're going to bring valuation into deal making, it has to be because you're buying something for the long term, and what you're going to get out of the deal are the cash flows or whatever you're acquiring. Which means there are only certain types of clients who are really interested in value. So everybody talks the value game, but most people, I think, want to play the pricing game.
Right.
For whatever reason, we've trained people into thinking that if they talk about value, they sound deep. If they talk about price, they're shallow. And I think that's part of the reason, much as we like to talk about value in transactions, ultimately it's a pricing game.
So when people conduct transactions and they approach us to say, can you do a valuation for us? So in effect, they're looking for pricing or justification to conduct the deal.
Exactly.
But there are times when we say the value, and if we do conduct a real valuation, capturing the cash flows, etc., of the potential of the business, they may end up executing the deal at a price below or above the value. Do you want to share some thoughts on that?
I think there are two possibilities, right? You do the valuation, one or two things is going to come out. Either you're going to confirm for your client that the transaction is a good deal, or you're going to caution your client that it's a bad deal.
Yeah.
I'll give you some bad news. If you tell your client it's a good deal, then in a sense, that's what they wanted to hear in the first place. So your value is almost a side story. To the extent that they can finesse the deal using a valuation, they will. I think the problem is when you tell your client it's a bad deal.
The bad news.
The bad news. And their first reaction is going to be, well, you missed something.
Clearly, you've done something wrong.
You've done something wrong. So the onus will shift back to you. Go find something else for me that will make this a good deal. And if you refuse, I'd love to tell you the client's not going to do the deal.
Yeah.
but I'm afraid that they're just going to walk down the street to find somebody else who will justify the deal. The problem in deal making is the deal gets done first. The
So
analysis follows.
the number is already predetermined, so you're looking for a disease for the cure.
Exactly.
Reinvestment of capital into businesses. How important is it to properly account for reinvestment when you're looking at or estimating valuations?
Well, I think it's not so much properly estimating reinvestment as being consistent about what you assume about reinvestment given what you're assuming about growth.
Right.
So you tell me a company is not going to grow and you tell me it's not going to reinvest money, I'm okay with that. If you're not going to grow, you don't have to reinvest money. But if you give me your plans and you say you'd like to grow 35% a year for the next 10 years, you plan to grow 35%. But then I ask you how much are you reinvesting and you're saying nothing. I have a problem with that. I have a problem with the fact that your assumptions are at war with each other. So when you think about reinvestment, you always have to think about it in the context of the growth you're assuming for a company because the two are locked at the hip. When you change one, you always have to think about changing the other.
Okay. You've got to have something to generate the money for you.
Yeah, these are not line items in an Excel spreadsheet where you can say, let me make growth higher and reinvestment lower. In an Excel spreadsheet, you can do that. But in a real business, those two things can't move in opposite directions.
So what's your advice to people who are looking to value startups and those difficult to do valuations?
Make your best judgments with the data you have. Be willing to change your mind when information to the contrary shows up. And be okay being wrong.
Right.
Now, if you can do those three things, you're going to be okay.
Have faith.
Have faith. With young startups, it's true there's a lot more uncertainty. You cannot base things on historical data. Your judgments are going to be wrong, horribly so sometimes, but you got to be okay with it.
Well, thank you very much, Professor Damodaran. It's a pleasure to have you and very useful insights from the professor himself in PwC Luxembourg.